Good afternoon, ladies and gentlemen. Welcome to a Standard Bank webinar hosted by SPFC, Standard Bank Financial Consultancy. My name is Ketwe Gunene. I'm the coordinator today. And the topic we're looking at is emotional biases and how they impact your investments. Please note it's the 1st of August today as well. So I'd like to say Happy Women's Month to all. I hope it's a good month for you. Today's presenters is Mr. Albert Lowe and Errol Mayer. But before I hand over to them and tell you a little bit more about them, I just want to do some housekeeping. First of all, I want to make sure that everybody can hear me clearly before we start. So if you don't mind, if you look on your screen on the right-hand side, there's a small panel. You should see a small high five. If you can click on that, it will indicate to me that you can hear me. And the more hands I have, then we can continue. Yolanda, thank you so much. I see your hand. Thank you, Sneyman. Thank you, Ray. Thank you, Roger. Thank you, Rian. Thank you, Peter. And all the hands are coming up. Nomsa. Thank you so much, ladies and gentlemen. I see all the hands. I assume the sound is good. And if your sound's a little bit soft, on your taskbar at the bottom of your screen or your computer, you will see the volume button. If you just put that up a little bit louder, that should be good for you. Second housekeeping factor is questions. If you have any questions during the presentation, there's a small questions bar as well on that very same panel where you clicked your high five, where you can type your question during the presentation. What we'll do is we'll address the question at the end so that we don't disturb the role of the presenters. I hope that's clear. So let me tell you a bit more about our presenters today. First, I'll tell you about Mr. Albert Lowe. He's got 25 years of industry experience. He's the head of business development at Stanley Multi-Manager, responsible for the business development function of the business. So Albert graduated from the University of Stellenbosch with a BCom in accounting and economics, and furthered his studies at the University of Johannesburg, which is UJ, completing an honors degree in investment management and postgraduate diploma in financial planning at the University of the Free State in 2017. And in 2018, he obtained his CFP qualification. Albert started his career at Absa Bank in 1992 as a credit analyst before joining consulting firm Ginsberg, Milan & Carsons in 1996 in their asset consulting division. In October 2006, Albert joined Sanlam's offshore hedge fund business, obtained financial services. After a 3-year period working in offshore designations such as New York and Switzerland, he joined Stanley Multi-Manager as head of business development. You always know that we bring impressive people to come present to you. Number 2, Mr. Errol Mayer. We all know our resident DJ, our resident presenter. Errol Mayer is a certified financial planner and admitted advocate of High Court SA. He holds qualifications in finance, law, teaching, and taxation. He's authored a book called Notes on Estate and Financial Plans, now prescribed for many universities. He's a renowned lecturer, examiner, and moderator for various universities in South Africa. He previously worked as a legal advisor for corporates and as a tax advocate for SARS. He currently holds a position of advisory propositions legal specialist here at Standard Bank, and that's why Mr. Errol Mayer is always sitting at the table with us. Good afternoon, ladies and I almost said ladies and gentlemen. Good afternoon, gentlemen. It's because it's Women's Month. That's why ladies are at the top of my mind. Thank you so much for taking the time out to join us today. I wish you luck. This should be about a 40-45 minute presentation, and at the end we'll address your questions. I'm going to hand over to Mr. Errol Mayer, who will start us off. Thank you, Errol.
Thank you very much, Katiwe. Well, good day, all attendees. Welcome to our final investment presentation for the year. And what better way to conclude with an investment webinar that analyzes our human behavior when it comes to investing. So where do we start? How can one explain the following made-up story? Say, for example, a punter asks you to give him 100 Rand to bet on a horse at the racetracks. The punter returns one day later and hands you 300 Rand, which means he has tripled your money. A phenomenal 300% return in just one day. So you give him back the 300 Rand and ask him to bet your money again. The next day he returns, but very apologetically gives you back only 150 Rand. You are furious since he's lost 50% of your money. But is your outrage justified? Because technically he made a 50% return on your money in just 2 days. Now, this is a typical example of how human emotions can quickly override logic. And this is what this webinar is all about. But is there a logical explanation why we react in such a manner? And Albert will share more light on this behavior in this webinar. But First of all, let us refresh our memories and explore the fundamental principles of goals-based financial planning, which, by the way, follows a process that, if fully understood, will help the investor to apply logic and not succumb to irrational emotions. It is by now tried that we at Standard Bank Financial Consultancy adhere to a goals-based investment philosophy in terms of which we select an appropriate investment for a particular lifestyle goal. So we have learned from previous webinars that the concept of term plays an important role, not only relevant when we look into the future and formulate a strategy to achieve a certain lifestyle goal, but also when we choose an investment strategy. When it comes to investing, always remember that compound interest is our friend and inflation is our enemy. Coupled with the longer term, the volatility of a goals-based investment can be smoothed out so that one can be fairly certain to achieve that lifestyle goal. Now, the concept of inflation is such an important part in a goals-based financial planning discussion. The crux of goals-based investment funds is for your investment strategy to deliver the maximum return for the minimum risk over the given term so as to achieve a lifestyle goal. But importantly, that it will match the higher future value of your lifestyle goal that will have kept pace with inflation. Therefore, the challenge is not which investment will give me the best investment return, but rather choose an investment strategy that has a high probability of beating inflation over the term until I need the funds for that particular goal at the end of that term. Whilst investing towards the lifestyle goal, we may have to increase the contribution or extend the term, but the main point is that the goal will be achieved because of the tailor-made goals-based investment strategy. Then, depending on your risk tolerance profile, some goals are more important than others, and so a financial planner can assist in prioritizing the goal and assist with the suitable inflation-beating investment strategy until the funds are needed for a particular goal. Now, the problem is that if we are not committed to a specific investment goal and a corresponding investment strategy, the financial plan and investment strategy may backfire. Short-circuiting the term may lead to disappointment from investment as well as from a financial planning perspective. Now, there may be many valid reasons why one does not stay the course over the investment term, such as a sudden need for money because of an unforeseen event, such as illness, and a risk aspect I perhaps have not appropriately dealt with in my financial plan. An example would be failing to protect my income stream if I become unable to work for a period of time. It is thus foreseeable that I may cash in my investment and experience disappointment because of the investment returns. To avoid this type of situation, it is imperative to conduct a proper, professional, flexible, and most important, an holistic financial plan. A typical holistic financial plan will identify all the risk areas, lifestyle goals, and prioritize them. This is embodied in a well-documented financial plan, and the advisor manages the financial plan together with the client. This ongoing management is the true value add of a financial planner to any client. Now, having said that, let us get back to my betting story. It is a fact that many investors do not stay committed to their investment and lifestyle goals, often because they let their emotions override their logic. Albert will explain the importance to identify these human emotions, or as he phrases it, how our brain sets little traps for us. And now I hand you to Albert.
Thank you, Errol. For the discussion this afternoon, you'll see on the agenda I've broken it down into four parts. Firstly, many of our actions are based on feelings instead of facts. We as investors make a number of investment decisions based on a host of emotional biases that unfortunately undermine our chances of meeting our desired investment outcomes. But admittedly, it is hard to escape the influence of emotions on investment decision making. In fact, that influence is probably the main reason why many of us don't get the investment results that we're looking for. However, being educated and aware of how emotions affect your decisions can be crucial in overcoming this risk and make you a better investor in the process. In order to improve our decision making and investment results, it certainly helps to, as step 2, be aware of some of the most common biases, how to mitigate these costly investment mistakes, and in conclusion, to focus, as Errol mentioned, on our goals and to think long term. To start with, as background on emotional biases, behavioral finance has been growing over the last 20 years, specifically because investors rarely behave according to financial and economic theory. We behave according to emotions and not logic. Most investors indeed know that our emotions affect the way in which we make investment decisions. We commonly talk about the role greed and fear play in driving investment markets. Emotional biases are therefore ingrained aspects of our human decision-making processes. But the reality is they may be unhelpful for achieving our success in long-term investing. Our brains regularly set little traps for us, emotional potholes, that sometimes have very real cost associated with them. So let me use this opportunity to briefly talk you through some of the common emotional biases that we confronted with on a day-to-day basis. Firstly is herd mentality. Because of our emotions, we may be influenced by the prevailing investment climate, a fear of standing out from the crowd or missing out on a trend. Let's look at a very practical example like the dot-com bubble in the late 1990s, where venture capitalists and private investors made frantic moves to invest a huge amount of money into internet companies, in spite of the fact that many of those dot-com companies didn't have business models that were financially sound. There were no logic and facts behind those businesses. The reason many investors move their money in this way likely has something to do with the reassurance they receive from seeing so many other investors do the same thing. Don't want to miss out. Follow the herd of sheep and not their logic. Secondly is greed and fear. Greed and fear relate to the old Wall Street saying financial markets are driven by two powerful emotions, namely greed and fear. Succumbing to these emotions can have a profound and detrimental effect on our investment outcomes. Too often, entering on greed or exiting the market on fear at precisely the wrong time. If we look at overconfidence, this because us as investors do overestimate the quality of our judgment or information. Some investors believe they can successfully predict market downturns and rallies. Others perceive themselves to have a knowledge advantage when they get a tip from someone in finance or read information from a publication or research report. The fact of the matter is, several studies have shown that overconfidence bias leads investors to trade more frequently in effort to align their positions with current market conditions. Unfortunately, trading more frequently has got a major cost implication, and it eats into returns, and rarely are the returns big enough to make up the difference. As investors, we are also very susceptible to forgetting the times that we were incorrect or recognizing the role luck played in positive outcomes. If you ever find yourself saying things like, nothing could ever go wrong, I believe it will go up forever, I know the risks, it's time to check yourself. It may help to remember that every investment carries with it some risk and potential for loss. As a last example, I touch on loss aversion. Loss aversion delivers a particularly powerful emotional sting. It's the idea that we rather avoid losses than reap rewards. As investors, we hate losing our money. In fact, we regret our losses more than we enjoy our gains. Loss aversion leads us to hold on to underperforming shares in hope of one day making up for the declines. Behavioral finance suggests that we as investors are more sensitive to loss than to risk and return. We as investors tend to feel the pain of loss about twice as much as we feel the pleasure of some sized gain. The idea of loss aversion also includes the finding that investors try to avoid locking in a loss. Consider an investment bought for 1,000 Rand, which rises quickly to 1,500. As investors, we would be tempted to sell it in order to lock in the profit. In contrast, if the investment dropped to 500 Rand, the investor would tend to hold it to avoid locking in the loss. The idea of a loss is so painful that investors tend to delay recognizing it. More generally, investors with losing positions show a strong desire to get back to break even. This means that we as investors generally show high risk-averse behavior when facing a profit, selling and locking in sure gains, and more risk-tolerant or risk-seeking behavior when facing a loss, continuing to hold the investment and hoping its price rise again. Moving on to the third step is how we mitigate some of these biases. How does one go about avoiding these emotional traps? And there I use the heading, a smooth sea never make a skilled sailor. Financial markets without volatility would be unnatural, like an ocean without waves. The market, like the open ocean, is constantly turning. The degree of market volatility varies from small ripples to rolling waves to a financial crisis-sized tsunami. It might sound scary, but volatility simply refers to a change in price. It is normal and happens over time. It is not necessarily a cause for panic, and it's something you should consider when investing. Start by understanding that the prices of, for example, stocks and bonds will go up and down, and there are some things you can do with that in mind. But even if market volatility catches you off guard, you can handle it. Many investors are uncomfortable with the large amplitude swings inherent in volatile investments, and this shun the risk and associated return that goes with the risk for less swingy, lower return investments. Since volatility settles out to be of quite little consequence over the long time horizon, avoiding the more volatile investment simply leaves a lot of potential return on the table, shaving thousands and possibly hundreds of thousands of your wealth at retirement. Paradoxically, avoiding risk in long-term investing typically leads to a smaller pool of wealth, making you feel less safe in retirement than if you had assumed more risk along the way on your way to retirement. So how do we respond to market volatility? It might sound counterintuitive, but during periods of market volatility, your right course of action might be to take no action. This is hard to do because volatility can leave you feeling vulnerable and concerned that you have to react. And one thing we can't show is the seasickness as an investor you feel when you have to ride these waves. However, focusing on the long-term trends of the market rather than the short-term movements should give you as an investor the confidence to ride the waves of volatility. When examining historic equity market data, we see a trend of rebounds following equity market pullbacks. That means that investors who jump ship after a big wave may have broken the cardinal rule of investing by selling low. Let's use a simple example. If you as an investor own a house and someone told you its value went down this year, would you panic and sell? Most likely you will not. You bought your house because you knew you'd be there a while. So its day-to-day price isn't as important. Chances are your home value will rise over time, and that's what you are focusing on. Also important then is to make mention of ride the waves of volatility. If you look at the slide, you can see we show 12-month, 36-month, and 60-month rolling nominal returns for the period from 95 to June 2018. And in the blue line is the important one. As you can see, our volatility settles down, it's smoothed out if you invest over longer term. Whereas as a 12-month example, you can see huge waves coming your way. And that should not be of a concern to you if you invest over the longer term. The next slide talk about a goal without a plan is just a wish. And acting on emotion may lead to irrational decisions and hard lessons. But importantly, if you develop a very sound investment game plan, as Errol alluded to in his introduction section, and stick to it, you're likely to be in a better position to pursue your financial goals and mitigate your emotions. Have a game plan. This can help you to remove your emotions from the equation, enable you to make the most of potential market opportunities, and help preserve your assets during these periods of high volatility. Investors should look to follow a disciplined strategy focused on asset allocation, diversification, investment selection, and ongoing monitoring. The last of these means that even though you have a long-term horizon, you don't simply buy and hold and ignore circumstances altogether. Any fundamental changes should trigger a review of your portfolio without necessary adjustments. Your financial advisor would typically be the best person to help with this reassessment. Unfortunately, growth assets are volatile and unpredictable. This does not mean you should avoid them. Uncertainty is only a negative for investors if you panic or become overly emotional about your capital. And also very important is how to offset market movements is to use the cost averaging way to invest. This is when you invest an equal rand amount in an investment at regular intervals, ensuring that the price you pay for the investment averages out over the period of time. When the price is high, you buy less. When the price is low, you buy more. And there is no guesswork whatsoever in cost averaging. This may mean you miss out on some of the gains, but it certainly helps reduce the sting of downturns. Investors, therefore, without a goal and a plan, are much more likely to realize the waves of volatility that occur over your period of investing. However, unfortunately, there's no assurance that your investment strategy will be successful. But with a clear plan, leaves you with a higher probability in meeting your goals and needs. Lastly, I deal with to be disciplined and stay invested. Let's get straight to the point. Although there might be many investors who have made money by seemingly timing the market correctly, in other words, predicting market movements and selling or buying shares accordingly, it's likely that many of these success stories are due more to luck than skill. But for the average investor, it is not only difficult to foresee market upswings and downswings, but also challenging to make decisions that aren't marked by emotion. The golden rule, it's about time in the market, not timing the market, as it's far more valuable to you as an investor. We know markets do not move up in a straight line, and volatility is inherent in equities as an asset class, for example. And while it may be tempting to try and predict wins and moves in the equity market, the only true alternative is time, or buying and or holding your investments. Checking your portfolio too frequently can make you more susceptible to loss aversion because the probability of seeing a loss in a short time period is much greater than over long time periods. As a result, investors that frequently check their portfolios tend to take less than optimal amount of risk. In other words, true long-term investors are more willing to allocate towards risky assets because they don't care about the short terms, ups and downs. Holding a portfolio for the long enough allows you as an investor to increase the probability of a positive return. In the next two slides, I briefly touched on holding, the importance of holding your portfolio for long enough. The two slides talk about missing the best days in the markets, one in the local market and another example I'll show you in the offshore markets. In this example, research conducted by Alexander Forbes shows that 100 Rand investment on the JSE would have grown to 1,760 Rand over 2 decades between 1995 to 2014. If you missed the 10 best days, your investment would have been worth almost half at 965 Rand. Historically, the market's biggest gains have come on a relative handful of days. If you're not invested on those days, it's very hard to make up for the missed opportunities. Another example, talk about the offshore market. Research conducted by Platinum Investments, investing offshore on the S&P 500, for example. By staying fully invested over the past 15 years, you would have earned roughly more $20,000 more than someone who missed the market's 10 best days. More than double. In conclusion, the last step of the presentation. The industry is learning more and more about emotional biases and the effects on individual investors. But it seems that adhering to a sound investment plan may be one of the best ways to avoid the pitfalls set by our brains. That may seem boring, but it can be an effective way to attempt to meet our goals. Remember, investing is always a marathon and not a sprint. You need to be patient. If you found yourself wanting or needing to take action out of hope, fear, or regret, turn to your financial advisor to challenge you and remind you why you're invested the way you are. Your advisor serves as an educator, a counselor, and sounding board, and can guide you to a blend of approaches meant to steady your emotions as well as your portfolio. I hope this session has provided you with some useful insight into emotional investing and impact on your investments. As investors, we are effective decision makers, but with flaws that can cause problems when it comes to investing. A better understanding, awareness of the nature of these flaws can help us to avoid these problems and invest better. If you remain focused on your strategy and ignore the noise, you can be financially free. I leave you with a famous quote from Warren Buffett: "Be fearful when others are greedy, and greedy when others are fearful." Thank you.
Thank you, Albert. So while Katiwa is just helping us here, perhaps from our side, perhaps just quickly summarize in a nutshell the ways to overcome our emotional traps. In other words, what is the main message here?
I think the important thing here is, as investors, we need to educate ourselves on how emotions can impact our investments. And then if you have an investment plan and focus on your goal, and forget about the noise out there, therefore have the patience and discipline, you can overcome your emotional traps.
Okay, well, thanks for that. Okay, now let me throw you a curveball. Now that Women's Month has started, who'd be the best investor, the woman or a man? Do you think there's an argument that women who are perceived as being more emotional are perhaps more logical when it comes to investing, given what you have told us about these emotional traps?
Well, that's a good question, Errol. I guess the answer is not what we as men want to hear, but I think a study found that men tend to be much more confident in their own abilities. It comes back to, I spoke about one of the examples of overconfidence, and it seems like men are more overconfident when it comes to invest than women, and therefore they're likely to trade more frequently, racking up costs in the process and often mistime the market. So I think the study clearly shows that it's not men, it's women. They're better investors than us as men.
Well, that's quite interesting. Okay, we've got a question here. It is from Khauta Natala. She says here, if you can have a look here, she says, "I am keen to invest in Bitcoin." And then continues, "Which platforms are safe to invest in?" Well, it's not quite what we discussed, but perhaps on Bitcoin, what would your response be?
Yeah, I'm not an expert on the Bitcoin investment in itself, but the only advice I can give to you is to see the thinking around using Bitcoin as part of your overall thinking and strategy you would like to apply with your investments, and when and where it fits in.
Absolutely, yeah. I would, you know what, I think that goes back to what I said earlier as well. You need a financial planning and investment strategy, and it's a composition and a combination of assets working together in order to achieve a goal. I think one must be mindful to think that if you can perhaps get the best investment return, that all your goals will be satisfied. I think there's a bit more to that, and Bitcoin on its own, I don't think will satisfy that one specifically. Yes, one more, if you can have a look, Albert. This is one about emotions. Now, this is Christina asking us. She says, good day. I'm interested in how emotions control decision making. What factors should one consider when investing? I think the focus is what factors. I think it would be about objectivity. One should have a plan in place. And you know what? I always say that if something would happen to me, who would I trust actually to handle my affairs? And do I choose a financial advisor? And my response is always, give me the one with good processes that follows good systems, and I will trust the system. And then it doesn't really matter who that financial advisor would be. I don't know. What do you think? It's just a statement out there.
Yeah, as I said in my presentation, we need to try to be rational, breathe deep, and take one step back. And as you said, Errol, you know, engage with your advisor that can give you sound advice, a good sounding board, and then also will guide you with provide you education on the emotional mistakes we make, and through that help you to follow a disciplined process in terms of your objectives and how you can achieve your goals going forward.
Yeah, and that's where the role of the financial advisor, I bet, comes in pretty handy and useful. So let me end this with the last question to you then. So when investing into a retirement fund, which is a long-term investment for many, we are limited in terms of Regulation 28 that prescribes the investment, and therefore limits the growth assets in your portfolio. Any suggestions what an investor can do in such an example?
Thanks, Errol. Yeah, I mean, I think one fantastic opportunity is the new tax-free savings option. It's a fantastic way to top up your existing retirement and discretionary savings. And we always try to save tax. We always complain that we have to pay more tax, but here the government has created an opportunity for us to save more, and we should embrace that. You know, for example, if you're a family of four, the husband, the wife, and 2 kids, you can save up to 132,000 rand a year, and that's a fantastic way to save, to have a tax-free saving. And what we tend to forget is the day when we cash in the tax-free saving after 10, 15 years, no we will invest for the long term, is that there's also no capital gains tax implications, which is a massive benefit. And you know, we talk about cost and saving cost. What your advisor can also assist you with is that there's no executive fees involved with the tax-free savings account. So you can also save on that by following this route to complement your existing retirement benefits.
Okay, well, look, I think we can, here's another question that came up. Let's have a look here. Look at this particular one. Shall we deal with that one with Snyman? What is the, Snyman asks us, what is the main difference between an ETF and a unit trust?
So the ETF is an exchange traded fund, and then you have the unit trust. The important thing here is obviously that they both investment vehicles or means for you to invest, but they're obviously governed by different regulation. For example, unit trust under the collective investment scheme, and so therefore you can achieve the same objective or outcome depending on which of the two vehicles you feel comfortable with to invest with. What you find is that many investors will make use of both vehicles, and others are comfortable only making use of one of the vehicles to invest their investment savings.
Okay, thank you so much, Albert. There's one last one, seems simple enough. Says, I'm invested with Stanley Money Market Fund. Is this a good one? And that's the last question. That is from Mila Panali. So
A money market fund is the good one.
It's a good choice, perhaps.
Yeah. Well, Stanley as investment houses have always had good credibility when it comes to fixed interest investments. This is a good money market fund from a point of view. It has delivered credible returns over the longer term. But once again, if I see money market fund, I always get worried because hopefully you want to save for a short-term goal. Because if you want to invest or you may need it for emergency purposes. But the important thing is, if you want to save for a goal or have a longer-term objective, then you should consider a a growth type portfolio, and hopefully through that you'll achieve your goal as part of your strategy.
Okay, thank you, Albert. That should cover it. That's all the questions for today. Thank you so much, gentlemen. And just to hit on the mark that Errol was talking about, if you are looking to get more advice, please walk into any Standard Bank branch. There's financial planners in all our branches, and ask for a financial planner, and that should be helpful to you with all your financial planning needs. If not, our communications team will be sending communication soon with a number that you can call, and a financial advisor can then call you and set up an appointment to sit with you and discuss more queries if you have any, or would just like to have a financial advisor in your corner. Thank you so much, ladies and gentlemen, for joining us. This was recorded on that very same communication that will come out. There is a YouTube link for Standard Bank YouTube channel where you can catch the recording of this webinar and all the previous webinars that we've hosted for you. We'll see you next time for our webinar. You'll get an invite soon. So hopefully you'll have the time to sit with us and join us for that one. Thank you very much. Have a good day and have a good Women's Month.